Thank you, Marla. Paul Hilton and I will discuss the real estate investment sales market. And for the theme of our discussion today, we'd like to borrow a phrase from a noted financial expert. And no, it's not Oscar Rogers, but rather former Fed Chairman Alan Greenspan. The theme of our topic today is the end of irrational exuberance. Yes, the pendulum has swung back from the high-octane days of 2005 to 2007. But if there's one thing we want you to walk away from today from our discussion, it is that deals are still getting done. So with that as a backdrop, let's take a look back at 2008 and some of the notable transactions that occurred in the St. Louis market. And we'll start with industrial. The Train Distribution Center building and the Trade Center 3 building both traded in the summer of 2008. Cap rates on those transactions ranged between 7 and 7.5%. Some of the major office transactions occurred throughout the year. We had National City in the first quarter, the Solutia building in the second quarter, and Lakeside Crossing 1 in the fourth quarter. Cap rates on those transactions range between 7.5% and 8.75%. Turning to multifamily, Reflection Cove and Prospect Creek were two of four transactions totaling $60 million that traded in the fourth quarter of 2008 at cap rates in the 6 to 6.5% range. Now, multifamily is probably the brightest spot on the investment side, and that's primarily because of the lower spreads and the high amount of liquidity that's been provided to the market by Fannie Mae and Freddie Mac. Let's take a look at retail. Well, retail activity fell off in the second half of the year for many of the reasons that Josh mentioned. Gloomy sales forecast, mounting store closings, and retail bankruptcies. But two of the major transactions that occurred in the first part of the year were Florissant Marketplace and St. Peter's Square. Cap rates on those transactions range between 7 and 7.5%. Now, one note that I'd like to talk about in terms of those cap rate ranges, in many cases, those would be much harder to achieve today.
As Mike just showed you, there were clearly transactions in 2008. But as you can see from this chart, transaction volume was way down. As a matter of fact, if you do the math, it was down 75% from 2007. That's the bad news. The good news is, if you look at it historically, we're actually in line with average sales on a historical basis. So what happened? Well, everybody has their own opinion, but so here's ours. We think it started with a credit crunch. The credit crunch led to an economic recession, which ultimately resulted in a stock market collapse, something that we're all personally feeling. Now, since credit is so important to the investment real estate market, we thought we would take a closer look. As you may recall, there are three traditional sources of financing. We had insurance companies and pension funds, we had banks and S&Ls, and we had mezzanine lenders. In around 1995, there was this new product developed called commercial mortgage-backed securities, or CMBS loans as they're known. CMBS loans accounted for over 50% of the transactions in 2007. Unfortunately today, you would be hard-pressed to find a CMBS loan. So with CMBS out of the picture, you're left with your three traditional sources of financing, which due to economic conditions are being very conservative on their lending policies. Now, how much of an influence did CMBS loans have in the marketplace? Take a look at this. You talk about the end of exuberance. We went from $230 billion worth of issuances down to $12 billion in 2008. The only reason there were $12 billion in 2008 is because those were deals that were carried over from 2007. Take this one step further. That's the same CMBS chart I just showed you. This is national sales volume over that same period of time. The correlation here is absolutely amazing. So I'm not here to tell you today that the CMBS loans was the problem. As a matter of fact, we believe the CMBS product is a good product for real estate, creates liquidity, and it works. The problem was Wall Street. The problem was greed. The big banks in Wall Street got greedy. There were a lot of fees involved with the CMBS issuances. That was the problem. They began to overlook a key component of real estate, and that key component is a four-letter word known as risk.